Welcome to The Explainer. We're going to dive right into this today because, frankly, we are talking about the single most expensive number you will ever sign your name to. To really understand it, let me introduce you to Joseph. So Joseph is 31, he makes a solid $85,000 a year, and he just found what you might call his realistic dream house. It's a $400,000 home, second bedroom slightly too small, but it works. He punches the numbers into his mortgage calculator, waits for his monthly payment to pop up, and when it does, he realizes something is terribly wrong.
Why does that exact same house cost almost $850 more today than it would have just a couple of years ago? I mean, think about this. Joseph hasn't changed, his income hasn't changed, the house certainly hasn't changed, it's still got the exact same popcorn ceilings, and yet an invisible market that Joseph has literally never even looked at quietly reached into his future and slapped the equivalent of a second car payment into his life.
Let's actually look at the math on this because the frustration is so real. Back in 2021, hovering around a 3% rate, Joseph's monthly payment on principal and interest would have been roughly $1,686. Today, sitting at around 6.5%, that identical house costs him about $2,528 a month. That is an $850 difference every single month. A house that was totally, comfortably affordable for him at 3% just quietly slipped completely out of reach. The finish line literally moved while he was running, and he couldn't do a thing about it.
Which brings us to part one, the invisible mortgage machine.
So who exactly is moving this finish line? We really need to uncover the big macroeconomic forces at play here, and honestly, we have to start by debunking a massive misconception. When your mortgage rate goes up, you probably picture a board of very serious people at the Federal Reserve sitting around a table, turning a giant dial labeled your monthly payment. You assume if they cut rates, your house instantly gets cheaper. But, well, that's incredibly clean, simple, and basically entirely wrong. The Fed really just sets one specific rate, the overnight rate that banks charge each other. That has almost nothing directly to do with the 30-year loan on your house. The Fed controls the shallow end of the pool. But Joseph, he is drowning in the deep end. The actual cost of his mortgage is decided by the single most boring yet most powerful market on earth, the bond market.
To grasp what this market actually trades, you just need to know that a bond is simply an IOU. That's it. The government needs cash, so it sells a piece of paper that basically says, hey, give me your money today, and I'll pay you back later with a little extra. That little extra is the yield. And here's the kicker. The government doesn't get to decide what that yield is. The market does. Lenders demand a really low yield when they totally trust the borrower, but when they get nervous about actually getting paid back, they demand a higher yield. It's honestly exactly like a credit score.
Moving on to part two, foundation, toll, and weather.
To really visualize how this hits Joseph's wallet, I want you to picture a giant machine with three moving parts that ultimately spits out your mortgage rate. First, you have the foundation. Since most people sell or refinance within about a decade, mortgages are priced against the super safe 10-year treasury yield. Second is the toll. This is the spread, basically the extra charge for bundling your mortgage into a basket and selling it off to investors. It's the fee they charge for taking on human risk. And third, the weather. This is just the daily fear, panic, and volatility swirling around the financial world. Foundation, toll, and weather. That is the entire machine.
Now, for most of modern history, that toll, the spread we just talked about, has reliably just hung out around 1.75 percentage points above the safe government yield. It was boring, it was predictable. But recently, it violently blew out to nearly 3%. Why? Well, first off, the biggest buyer in the room, the one with infinite cash, the Fed, quietly packed up and walked out of the mortgage buying business. Add to that jumpy investors who are terrified you might refinance if rates drop, and boom, they pass that massive extra cost straight down to Joseph.
Let's look deeper in part three, a straining system. We really need to look at how this pressure builds up because we have to talk about the underlying cause of all this market anxiety. Now, I have to warn you, the math on this next part is staggering, and it explains exactly why the foundation of that machine is shaking so hard. The United States government owes a truly enormous amount of money. We are talking in the neighborhood of $40 trillion. For a long time, investors were totally calm about lending to the U.S. long term. They barely charged any extra risk premium at all. But that just changed. Lenders are looking at this massive TAD and waking up what's called a term premium, an extra charge just to feel safe locking their money up. And listen, every single tick up in that premium is a tick up in Joseph's monthly payment.
But incredibly, that isn't even the scariest number. The government right now spends over $1 trillion every single year just paying the interest on its debt. Just to put that into perspective for you, the government now spends more on interest than it spends on its entire national defense. It is absolutely wild when you really think about it. When nervous lenders see a borrower adding trillions to the tab and spending more on interest than on defense, they absolutely clear their throats and demand higher yields.
Because of this, specific cracks are starting to form in the foundation. We've actually seen official credit rating downgrades for the U.S. We're seeing noticeably weaker treasury auctions, where buyers are just flat out demanding higher yields to take on the government's bonds, and massive international buyers, like China and Japan, they're quietly stepping back. Japan, for instance, has to sell American bonds just to defend its own currency, which pushes U.S. yields even higher. Every time a nervous buyer nudges that 10-year yield up a hair, it directly adds real dollars to Joseph's future kitchen renovation problem.
Okay, part 4, the lock-in effect. It's crucial to understand that this system isn't just out there punishing buyers. Let's flip the coin and look at the millions of current homeowners. A staggering 50% of American homeowners are sitting on a mortgage rate below 4%. Nearly 70% are below 5%. This is the famous lock-in effect. People like Amy, and she represents tens of millions of current homeowners, would have to roughly double their monthly housing costs if they sold their home today just to take on a new mortgage at current rates.
Because of this math, Amy's amazing 2.9% rate essentially acts as golden handcuffs. She literally turns down a much better job across town because the new commute just isn't worth doubling her mortgage payment to move. So she stays put. She takes out a floating rate home equity line of credit to get some cash for renovations, completely unknowingly exposing herself to the exact high short-term rates she was trying to dodge in the first place. And here is where it compounds. Because millions of Amy's totally refuse to sell, the housing supply completely dries up. This aggressively squeezes buyers like Joseph from both sides and just keeps propping prices higher and higher.
This leads us to part 5, navigating the mortgage market.
Okay, so the machine is straining, the math is frankly brutal, and honestly, no single person is the bad guy here. But how do we actually survive it? Let's pivot from validating this economic pain to empowering you with some historical context and actionable strategies. First up, a quick, empathetic reality check. If you think today's rates are the apocalypse, history would like a word with you. Back in the early 1980s, the 30-year mortgage rate peaked at over 18.6%. At that rate, Joseph's $400,000 house would cost around $6,000 a month in just principal and interest. The bond market has been this grumpy before, so please, you shouldn't feel like a personal financial failure for hesitating today.
So, where exactly does this go from here? There are 3 honest directions. Path 1 is the optimistic path. Inflation cools down and rates ease back into the high 5s. Path 2 is the grim path. Deficit fears get way worse, auctions fail, and rates climb to 9 or 10%. Then there's path 3, the muddle. Rates frustratingly bounce around in the 6 to 7% band for years while the lock-in slowly thaws and people's incomes slowly catch up. Historically speaking, the muddle is the most likely scenario. We have to stay ready for it.
Being ready means making the right structural choices right now. Let's quickly compare loan types. A fixed-rate mortgage is not just a loan. Think of it as insurance. You pay a slightly higher starting rate to make absolutely certain that none of this bond market chaos can ever touch your monthly payment. An adjustable rate mortgage, or an ARM, it starts cheaper, sure, but it essentially hands the incredibly volatile bond market a key to your front door. Unless you are absolutely 100% certain you will move before that loan resets, an ARM is incredibly dangerous right now.
You've probably heard the saying, date the rate, marry the house. If the house fits your budget today, and I mean today, not at some hoped-for magical future rate, buy it. Because if rates drop significantly, buyers are going to flood back into the market and drive prices straight up. You can always renegotiate a rate. You can never, ever change your purchase price. Just set a strict emotionless trigger. The moment rates drop by 3/4 to a full point, you refinance. Do not try to wait and outguess the market for another quarter point, because that window always shuts when you aren't looking.
Finally, I want to leave you with this thought. If you're doing everything right, saving your money, working hard, and the math still just doesn't work, you are not a failure. A market that you cannot see and certainly didn't vote for repriced your life. You get to completely opt out of the shame. Remember this quote, "The goal was never to own a house. The goal was to be free." Sometimes the absolute freest thing you can do is look at a rigged mathematical setup and calmly decline to play until the odds get better. Are you going to let an invisible machine dictate your freedom, or are you going to use this knowledge to master it? Think about that.